Hello, Warriors. How you doing? Ingmar, Richard, Kareem. Everyone doing okay? Day
Morning,
before.
Dale.
Hi, Ryan, buddy.
How you
Day
doing, mate?
before. Okay. A little bit tired.
Yeah, good early morning, Dale. Hope you're
Hey,
rested.
buddy. Buddy, how are you? So, getting some decent follow through in the metals here. I think this was an important week in gold and silver, and higher likelihood the low is in. Gold still outperforming silver. They're trying to turn this gold silver ratio, but doesn't look like it yet. Guys, they're trying to squeeze shorts a little bit in the euro. See how this line I talked about yesterday, it actually got over it, but couldn't close above it. I'd actually like to see one more low because see the RSI because of the last couple bounces. Talked about it that it was confirming down here. So if we get one more flush initiated by Powell into next week, 98, something like that, maybe just do a quick arithmetic, call it from 99 to what was this? Par 130 would give you 97.70. Just doing the arithmetic of the range and breaking down from the range. That's what I get there. Yen, I noticed yesterday that even though yields were stiff and they still look like they're not done, that the yen didn't have the same type of momentum. And I wouldn't mind a hawkish Powell. I think it would set up a nice shorting opportunity here. Canada is, the commodity currencies continue to perform. Yesterday, it looked like, maybe we would get one more break under here. I don't think that's going to happen anymore. And Blake said yesterday about the dollar when we were trading up here that it had room to go lower before higher. And that's what it did. Almost looked like, some type of ABC. And we have one more shot to the upside from here, as long as we don't, close under, say, 107.20. So everything's kind of set up for Powell tomorrow. And we'll see if he's hawkish. What you want to look at is what holds up the best isn't making new lows. If he's real hawkish, and most likely sets up, breaks to buy in gold and maybe back at 1750 or so, or silver, which is weaker. I don't know, 1960, in 1910, $19. And Blake kind of nailed the support as well here at the 4100 level. Maybe you get one more shot down to like 4080 or so on some hawkishness, but it's not, equities are not acting bad with what yields have done.
Yeah.
So
There's
enough
a,
of me, huh?
There's a big options play going on in 10 years, expiring Friday. Some 30,000 contracts on a block trade, premium of just under 5 million, which in the trade sort of needs or is looking for 10 years to be down at 2.9% on the expiry tomorrow.
Oh, wow.
So it's a fairly substantial trade. So, throw in Powell into the mix and everything going on tomorrow. If we do get any shenanigans in yields that go against whatever's going on with him, that might be the reason, particularly if we get down under 3% again.
Definitely very contrarian bet here. And gosh, I've heard of expiration poker before, but I don't know when they put it on. Put it on yesterday?
We heard about it yesterday.
Okay. All right.
But I don't know when. Let me see. It seems like it was put on yesterday. Certainly put on a short time ago, but it's a big single trade, so there would be some interest there to push the price around if it could trade on the right side. Just one of those things you need to be aware of in the market outside of everything else going on.
Okay.
We've got a big euro-dollar expiry today, 3 billion going off between 00 and 20, 10020 today. So,
Oh, well, they saved this one. They saved, look, went almost right to the strike.
Yeah, it flopped around it, and I was looking to see if it would hover around today, but we are, now 30 pips odd under, 25, 30 pips under, so we shall see.
Now these guys know they're like late, Vegas bookmakers, how they can call a spread and things like that. It's amazing. And it's worth paying attention to, and glad that you bring these things to the table, because it kind of gives you an idea of what contrarian things can happen that you're not expecting. K-Man, what do you think in yen? Still range bound, neutral?
Still very range bound, yes. I think the first levels are like around 136, where your red line is, and then the top side exactly where the blue line is. And we are going to trade in between, I guess, until Jackson Hole. So we will have the combination of Powell and Kuroda. But Bank of Japan Nakamura said this morning that it's too early to start tweaking. So I'm actually a little surprised the yen is not a tad weaker on the day, but it's just copy pasting probably the 10-year, and then the market managing their positions a little bit ahead of the whole. Okay, Powell speaks tomorrow, but there's I think it's George. She's giving her welcome speech today, I reckon, and from then on we can expect a lot of lines, I reckon, from the participants, the hotel doorstep lines probably. So it's really kicking off later today. But okay, the market is now getting ready for Powell tomorrow, which will be the main event.
Another correlation breaking down. I mean, the 10-year yield and the yen do not look like they're correlating right now.
Yeah, it's one of those. It's been like extremely tightly correlated. But then ahead of a main event, market leaves the ship a little bit. What is to note, though, is that even if dollar yen is not rising, the commodity yen crosses are still very big. Aussie yen, Canada yen, and some of the emerging markets as well. So rather than the dollar, it's those currencies who seemingly are taking over.
Okay, and
about your silver, you were mentioning silver before. I have a bit of a level around 1940, and that's exactly where it capped today. So I think range, kind of a range, 18. Well, the 1870 was a really great call, by the way, great line down there. 1916 perhaps a little close for comfort, as the thing tends to move around a little bit, but anywhere sub 1900 towards 1880, 90. I'm
buy a pullback.
Pretty interested. Yeah, I was long. I sold some out, and now I'm waiting for a pullback to see if I can get some lower down, perhaps on Powell. Who knows?
Yeah, some of the miners are starting to look good. Here's one that's, I think, is turning. Okay, that's and then the silver juniors, it was perfect. You know what I mean? To 78.6 with silver looks pretty good. And then some of the real juniors, like this one, even took out 78.6, but turning back up. So it's embryonic. If this is just starting, and the yen is in for a longer corrective period, the metals should continue to do okay. Do you have a strategy in the metals here, Stel? Buy breaks?
Yeah, obviously I'm waiting for Powell. I'm not doing anything before. I'm looking at silver, as everybody knows. I will either buy a breakout higher.
Where would that be?
What do I mean breakout? You know me, I don't day trade. My level is a daily close above 21. So we're a mile away from that.
Okay.
Yeah. Anything below that, I still think is noise. And I'll be definitely looking at the lows in the low 18s if we get there again.
Okay.
So for now,
this
I'm
is
not
the
doing anything.
breakout above
Yes.
these highs for you. Okay.
Yes, and I'm going to go in wherever the market is. Same as remember yesterday, I was saying when the market opens, I'm going to buy URA, the ETF.
Yeah, great trade.
So it opened at 21 something. I got 21.20. And now it's pre-market 22.80. You know, it was already up 5% when I got some. I don't care. You know, when I want to get into something, I just get in. And
yeah, you're not price sensitive.
Not that price sensitive because I'm not a day trader. You see, it's different to a lot of people. So I've moved my stops out to break even on that now. So I'm happy. And similar strategy on silver, but we're not close to any of my 2 levels. So I'm still watching.
Yeah, the uranium, that's an ETF you bought, not a
ETF,
miner.
yes, it's an ETF.
Because I remember Shy Girl a long time ago was in this. I think it's a royalty. You know, it's not a mine. I think they just collect royalties.
Okay.
Roy. Oh yeah, uranium royalty. So there you go. Not as strong as, and I think it's what, Cameco is the big uranium mine that a lot of people trade.
Very volatile, very volatile.
What's the symbol on that? Do you know it? Cameco?
Oh,
CCX or something like that?
something, yeah, hold on.
Let's see.
CCJ.
Okay, are you glowing yet from being in this trade? Huh, buddy?
That's his tan, Dale, from the beach.
Huh? Look at that.
His suntan from the beach. It's give Lagarde a run for her money.
It's good to get lucky sometimes, you know, with the entries.
I'm not against, So you bought a gap higher opening and you're in the money. Congratulations on that. Mr. Volge, hi, how are you, Steve? You watching the markets? Well, I thought I saw him here.
It's okay. He's doing all sorts of stuff in the background, so he might.
Okay.
I am here. Sorry,
he's here. Okay.
Until I switched on, I had my speakers on, you know, and I was doing some work. So until I switched on my headset and my microphone, took a few seconds.
What are you thinking going into Paul? Any ideas? And that was remember when no one would commit to an idea? That was a great call you made in US dollar yen when we were closing before the interview.
I think
that
the market is, for the time being, still positioned better for dollar strength and equity market weakness. So, of course, I can't predict what Powell is going to say, but sometimes when you are ahead of some kind of a binary event, in this case, you know, it's kind of a binary event because the market has set somewhere the threshold and waits to see if Powell is going to be on the left or on the right side of it, right? Having to do with less hawkish or more hawkish than the market currently prices in, right?
Yeah.
So
usually it goes with the trend on a binary event, the probabilities.
When something like that is about to happen, I think that the only thing you have to do is ignore, if you want a position ahead, is ignore what's about to come and purely look at the charts from a technical perspective, right?
Yeah.
So if I do that at the moment, I more or less see a bullish pennant in the DXY, for example, and I more or less see a little bit of a corrective recovery in the last leg lower we had in equities in the S&P, for example, which is the benchmark for risk assets, right?
Yeah.
So I have to say that if I had to position myself ahead, I would be looking for probably Powell to end up pushing the dollar higher and equities lower. That's what I think.
Okay. You have any numbers in mind? There's a lot of people are saying there's important support at 40.80, 40.50 at the big round number.
Are we talking about the S&P? I'm assuming you're talking about the S&P now, right?
Yeah, I have the chart up here.
I think that resistance is now in this bounce at 4,200.
Okay.
And I think that if we break through the recent low at 41.15, then we're probably headed towards
4,000.
39.80 roughly, so a little bit lower than 4,000 is my next downside target. Yes.
Okay, buddy.
between 39.75 and 4,000 is a cluster of supports I have.
Okay.
Yeah, we have a very nice impulse from that recent highs. Hey, Steve, hey, Dale.
I agree with you,
hey,
Gregor.
Gregor.
So from what I understand, Gregor, you're on the same page as I am, right?
Yeah.
So this was impulsive, Gregor?
Yeah,
This
exactly.
first break?
Yes.
You could count 5 from
5 down, and you can already see maybe some small free up.
what?
Or maybe
1, 2, 3, 4, 5?
Exactly. And now
Yes.
corrective rally, yes.
So
Yes.
could we get after Powell, this is A and this is B, and then we get a C?
Or maybe sharp wave B as well. It's very possible. I mean,
Yeah.
here is the resistance. I'm not sure what's your moving average there.
42.23.
Yeah, around there.
That's
I mean,
that's the 4 hour.
We have a previous we have a previous high at 42.04. This is the resistance area I'm looking for first.
And could also be a head and shoulder stop as well.
Oh yeah. So Greg is talking about this with 4,100. That could take you down to 39. This to me looks like the line in the sand, around 38.5. And we take that out, I think there's, opens it up for new lows. What do you think, Greg? Are you looking for new lows here? Or
no,
is this
not really.
The big question, the big question is this whole rally that we had this summer, is this sell-off corrective to consolidate these gains before we take out the 200-day? Or is this a resumption of the bear market and we're on our way to new lows?
Actually, I am aware that this could be wave 4 now, taking back price towards 4,000. And that's where we will see if the key support will hold. So it can be still only a temporary pullback. I'm not convinced regarding the bearish case for a retest of June lows. I still think that this could be more neutral phase right now.
Okay. All right. Is gold and the metals telling you anything? They constructive? Was this wave 2 after a 5 wave advance and we're ready for 3?
Yeah, it's very possible, but I have to admit that it was a very deep pullback and quite sharp one. So as long as we are below 1800, it's really tough for me to say that we are going higher. So I just need more price action on metal. Somehow I'm more neutral there.
Yeah, it sure held the 61.8 intraday retest the other day.
Yeah.
Okay. All right. So anything else you want to share? You want to take over the screen? We have 13 minutes left, or maybe Blake wants to get in here, or maybe he's enjoying just listening.
Man, I want to get in here. I got to talk. I'm sorry. I've been kind of busy doing a few other things too, but how I just heard I heard you guys' opinions, and I want to point out that Nick in our chat room is also known as Grasshopper. He had mentioned that after Powell speaks, the last 5 events I think he looked at that Powell spoke, the markets rallied right after that, and then they fell, the days following. One of the things that I do want to continue to I want to point out again, and let me go over to
grab the charts, buddy.
Yeah, I'm gonna go over to the charts really quick. As we discuss this, and we pointed this out on the 23rd. So this is 2 days ago. A gentleman in Twitter. He's very well known. He's actually a friend of like Helene Meisler. He's a hedge fund manager. And he's out in the Midwest. We follow each other on Twitter. Anyway, he pointed out that there's only been in the last 25 years, there's only been 3 other times.
Oh yeah.
That people have been positioned so bearishly in the markets via short basically. And all of those times we resulted in a rally. And then I was talking to Mark Chandler of Bannockburn Forex, which his interview will be out here in a little bit. It's definitely worth everybody's watch. So make sure you guys here. Let me grab this link, and I'm going to put it in the chat box. If you guys are not checking this every day, you should be. One of the reasons why. Let me grab again. Where the hell did my chat box go? Oh, there it is. I'll put this in for everybody, just so everybody goes to the right, tradersummit.net. Every day there's articles that are uploaded from different analysts, but Mark Chandler's will pop up here probably on the front here. You'll see his face. I talked to him yesterday, and he really is in the camp that the market will look through what Powell has to say and find, you know, anything that's dovish and cling on to that. Okay. And that's important, because if you look at the S&P, what's really important about the S&P where we're currently at, and let me delete this really quick. What you'll notice here is, even though we've got this big old head and shoulder pattern, and let me, yeah, this is a good view here. You take the latest run, you go to the high, you'll notice that 38% retracement comes in right around 4,100. It's 3090. I have it at 3090 on a different feed, and you know, depends on what CFD, what feed, but whatever you're looking at, these recent lows is just near the 38% retracement. Now, there's a couple reasons why that's so important technically. One of the reasons why it's so important technically is because when you get a move, and let me draw this out for everybody so you can really see it. When you get a move like this, I don't even like that. Let me get that a little thicker here. Okay, there, this is going to be better. So when you get a move like this and you only pull back like a 38% retracement, that means that, you know, it's a shallow retracement. There's a higher probability of an AB equals CD or an equal leg move, higher. Okay, when you have such shallow retracements, and that's one. So that means if we can hold this, that's bullish for the market. That means there's a really, really high chance that we test the 200-day moving average and possibly break it higher. Now, knowing that the market's so positioned short right now, I know, you know, a lot of us look around and we go, well, how in the hell is that going to happen? I mean, like, really? I mean, you know, we've got, you know, possibly deflation, stagflation, the market, the economy is slowing, blah, 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 blah. Look, the stock market isn't necessarily the economy. And that's one thing that I've had to segregate over the last, you know, quarter century of me trading, is understanding that the S&P is not the economy. And Trade Journal just said, yeah, it's the same with the euro. Yeah. I mean, look, the euro should be trading at like 80 cents as far as I'm concerned, but it's still hovering around parity. Don't ask me why, because I don't know why. It should be at 80 cents. The euro doesn't necessarily represent the Eurozone, you know, as far as the economy goes. So, you know, you can draw the same conclusions with the S&P. So what I'm trying to say here is be careful being short while we're above 4,100. Now we get below 4,100, it's going to be a different story to me. I'll say, all right, well, now that does make sense. This big channel that we're in is probably going to continue to stay relevant. And because look, I was bearish when we were up here at the 200-day moving average. I was short risk and did well. You know, but now that we're here and we're holding, you know, and knowing what we know right now, it's you know, it's a little iffy, and you can see the market's very hesitant. I was talking to from Pepperstone, I was talking to Chris Weston, and he said, yeah, even bulls aren't even hedging right now. Well, not aggressively, which is a problem. If the markets do fall, that means they're going to have to sell. But what's interesting is they're very confident about current levels they're at in the markets. So that's another thing. One last thing that I want to point out just technically is that we had this ascending wedge. We had a reversal out of an ascending wedge, which is very classic by the book technical analysis. But we've also met our first and, you know, minimum objective of coming out in an ascending wedge. Now, most of the time when you get an ascending wedge, you can usually target the 50% or maybe even the 618, but we have met the minimum requirement as far as I'm concerned. So it is possible that we actually reverse and go higher here. So I know everybody's leaning short. I get it. I understand. I want to be short too. I think this market, I think the S&P should trade closer to 2,500 than 4,000. Me personally, that doesn't mean I'm right, and that doesn't mean that, you know, that's what's going to happen. I think
people are going to call this a bear market rally all the way up to new highs, aren't they?
I don't know if we call it a new market rally or a bear market. I don't. Well, I think.
Well, that's what everyone's calling it.
Yeah, I think it's a bear market rally, and getting all the way to highs like up here would be pretty wild. I can't see it. Like, I don't see it. That doesn't mean it can't happen. I just don't see it. But like, look, if we get a rally like that looks like this.
Yeah.
And we see a rally back to 4,700, just shy of the all-time highs, and make like a longer term lower high, and then sell off into 2023 as we go into a pretty heavy recession in the US. I think that's realistic to believe.
That's David Keller's target, and David will be with us in 5 minutes.
Oh yeah, David Keller is coming up, right? Yeah, he is. David Keller is coming up, so that's cool.
We spy on you, David, to know what you're talking about. I don't know if he's.
I remember I told you he was targeting like 4,700.
Yeah, right.
But I didn't watch the video, so I'm going to be interesting. I'm going to be interested.
We want to know the whys, right? How?
What's that?
We want to know the why and the hows he came up with that.
Right. And remember, he is a CMT. So you make sure you guys stick around to listen to Dave Keller in just a few minutes. But I just wanted to deliver that message ahead of tomorrow. And we're all going into the Jackson Hole Symposium. Everybody's going to be watching, what happens, or what Fed Chair Powell has to say. Obviously, other Fed chairs are going to, Fed governors are going to be important, and other central bankers, you're going to be listening to them and what they have to say. But everybody's going to be watching the Fed Chairman Powell tomorrow morning at 10 a.m. And look, if the market sees anything that is not uber hawkish and like he's staying the course, if he starts going, well, inflation is, a little might have peaked, and, global PMIs are starting to weaken. He sounds dovish at all, like says anything like that. The S&Ps are probably going to be trading back at the 200-day moving average by, next week, and a breakout and a short squeeze, a proper short squeeze, is entirely possible. And I don't want to rule that out. One other thing I should point out here. If you take the all-time high to the low, right? You can see that right here, right? All-time high to low. The 618 retracement is at 43.70. If you take this last leg lower, so this is the high here to the low, 127% extension of this move comes in at 43.70 as well. So what I'm going to tell you is, I think right here, there is unfinished business with the market that is above the 200-day moving average, and that would be just enough to crush everybody who's short, and then reverse.
I think new longs will come in there too, Blake.
Yeah, and then you get new longs, and then you get them wrong-footed. I mean, the market likes to screw as many people as possible, as often as possible. So if the market is leaning in one general direction, which happens to be short right now, how do you screw them? Well, you put us right back above the 200-day moving average and at 43.70, and maybe Dave Keller is right, and maybe we trade a lot higher and do this AB = CD type of move. Again, I'm throwing out warnings. I am not long, but I am prepared to be long risk, right? So that's just
Victor Sperando last Friday and said that Powell wants to help the Democrats. I said, well, it's a former president that appointed him. And he said, well, it was a bad appointment. But anyway, he made it political.
Yeah, I think people forget, that
they're not supposed to want to help anybody or hurt anybody.
Was appointed originally by Trump, and so and it's not political. He's doing whatever is going to best serve his family and friends.
Victor.
I mean the United States.
Yeah.
I'm sorry.
Oh, what? Thanks, Anthony. I don't think Victor was that happy about it. Anyway, so team.
Oh,
go ahead.
Yeah, I was going to say we got about 1 minute. Do we have data coming out?
We have GDP.
We have GDP coming out, and you're just
but
now
it's the second
revision.
It's a revision, so it's not.
I got
something.
15 seconds till GDP is coming out, and you're
jobless
just
claims
now
too.
What you've been sleeping at the wheel, Stelios?
We're just blabbing too much. Don't blame
I know. Maybe that's it. Maybe I had you just so mesmerized by my conversation here.
Jobless claims.
What does GDP numbers have?
Jobless claims slightly better than expected. GDP minus 0.6. So down 0.2%. So sorry, 0.2% higher than the previous estimates. So
jobless claims are a little bit better. Look, all this data, good for the dollar, bad for stocks. It's the same. We live in the upside down via Stranger Things when it comes to data and the way the stock market is going to respond. But stronger data is typically a little bit. And I know some of you didn't get that reference. Sorry. But yeah, the jobless claims, like I said, better. GDP price index better than expected. Yeah, dollars moving higher, stocks are moving lower.
Right.
Whenever you get
it's
that
setting
good data,
that up for the fade into Paul. Anyway,
what's that?
Setting up the fade after Paul is hawkish tomorrow, maybe.
Exactly. Just so everybody here knows that I've been taking down my positions from this week, kind of winding them down. I still have some positions open. If you're in the ForexAnalytix community, this is what the ForexAnalytix community looks like. This is on a very slow day where I haven't even posted any charts this morning, but that's just from like the last couple hours. But in our trades room, you can actually see what open positions I have. I post them here in the markets, and not just me, but other traders, other people from our team. We have the Flowonomics room, which is the macro chat room. Lots going on in our community. It's probably one of the most active trading communities, even in a late summer month when a lot of people are actually out on holidays.
We're committed action junkies here.
What a lot of us.
Yeah, we're committed.
Yep, committed action junkies in the ForexAnalytix community. Also, check out the Trader Funding Program. We've had multiple people get lit up for live trading accounts this week.
Just do
it. Well, this is a great way to access larger amounts of money, not take any of the risk, but keep 75% of the returns. If you want to learn more about that, go all the way down to the bottom, watch a 2-minute video here. Like I said, we have 8cap is the broker that facilitates our prop trading. All right, guys. Hey, thanks everybody for tuning in today. And thanks team for being here. Sorry I didn't get to interact with a lot of you guys that were in here, but thanks everyone. And Dale, it's all yours.
Dream team. I tip my hat. And Blake talking about upside down makes me think of a Jim Morrison song. Markets are strange when you're a stranger. Strangers come out of the corner to stop you out. Anyway, David Keller. Welcome back to F.A.C.E. People are strange. Markets are strange. Welcome back, David. We've been stalking you, and we know you're looking for 4,700 in the S&Ps.
Great singing, Dale. Good morning. How are you?
Great, buddy. How are you?
Good morning, Dave. I just want to say hello before I check out.
Hey, yeah, Blake. How you doing?
Good. Yeah. Dale was just mentioning that I saw a headline in one of your videos. S&P could see 4,700. I mentioned it to Dale like a couple of days ago. He's like, well, I have Dave coming in on Thursday. I'm like, great. This is exactly the person we want to talk to and see what you're thinking. So have a great interview, you guys.
All right. Thank you, Blake. So David, you want to share the screen and lay out your case for 4,700 S&Ps?
Yeah. It says I can't do it until someone stops sharing.
Oh yeah. There
we go. Okay. Yeah. Perfect. Here we go. Can you see my screen okay?
Yep, got it.
Yeah, so we are in a really, really interesting time, and I feel like you could have said that many times in 2022, but especially now. And the first 6 months of the first 6 months of this year, I mean, when you now looking back, pretty straightforward, right? And you had this consistent stream of data that just seemed to further facilitate the bear case, right? And you could see how with the Fed taking the action they were, the prospect of higher rates, the stronger dollar, which was sort of the wrecking ball for risk assets, kind of everything's going down. But a lot of things have changed from mid-June to mid-August. And, you know, when you think about an upside target in the S&P, you're basically assuming that what's changed is what is going to be the future here for at least the, you know, foreseeable future, that you continue to see optimism that the negativity, all the macro negativity, which is still there, and that's the kicker. If the market does rally from here, it's in the face of a lot of macro headwinds. But I think I caught Blake saying, yeah, I caught Blake talking about the difference between the stock market and the economy. And a lot of people, you know, incorrectly look at economic conditions as a way to try to understand, you know, to project what stocks are doing. And you have to remember, you flip that around, right? The stock market is the best leading indicator of the economy, not the other way around. Yeah. So from a purely technical perspective, we've rallied from 3650, we'll call it, up to around 4300 in a pretty short amount of time, in about 2 months. And that rally has created a very different look to the equity markets. You know, the biggest rally in 2022 by far, right? And the March rally was the last one that was the closest, but this one has far eclipsed that. We've gotten to the 200-day moving average, which was, you know, unthinkable when we're down at 3650, but now obviously very accessible. Now, however, we've pulled back, right? So we hit resistance at the 200-day. A lot of individual stocks hit resistance at the 200-day, and stocks like Apple hit resistance at all-time highs, right? So there's a lot of overhead resistance right now. So how do we make sense of things now, right? So I think we're in an interesting environment now where I'm hearing very bullish and very bearish sentiment and perspective from technical analysts that I respect and follow. So it's a very conflicted market. And I got in Blake's comments, I got that. I sensed in his voice sort of a conflicted trader. I could see the bullish argument, but I could see the bearish argument too. And that's what makes it so challenging. So what I like to do in this sort of environment is lay out the guide rails, right? Lay out the levels, the line in the sand at which you accept that the market is different than what you'd expect. So how would I sort of summarize all of this? So number one, we've rallied significantly, but we've not rallied to the point that this really, in my opinion, looks bullish yet, right? Completely, it's so obviously bullish that you just can't be bearish anymore, but we're not far from that level. And I think that's the 61.8% retracement level, which is just about 40 or just below 4370. So the S&P gets to that level. I don't know how you could hold on to being bearish, because I think that really indicates that the market no longer cares about these macro headwinds. We're seeing optimism because of all the things that the Fed is doing. Interest rate hikes are working, and you know we're going to kind of get through this. If we do get up to 4,700, which would put us pretty much near all-time highs, what I can't imagine is us getting significantly higher than that without a major drawdown. And I think that could be setting us up, thinking of the seasonality, into weakness going into next year. But I'll come back to that in a second. Okay. I think the bear case for the S&P is we're not far from it, right? We sort of have this rally. If you look, I mean, one of the things I would take with any of these is, so I drew it here, right? So just taking the low in June, the high in August, 38.2% of the way down is around 4060. This shaded area on my chart here in red, which is right around 4,100, I've had on here for quite some time, because that was actually the low back in February. That was also right where the rally stalled out in May, right, or just below that. So the market holds this, and this is the beginning of something more meaningful, right? This is the beginning of something more significant. This bull case that I'm talking about, we get below 4060, and all of a sudden you have to accept that it's more of a retrenchment before a rally. So here's the kicker, though. Seasonally, August into September tends to be pretty tough for stocks. So if the market would just go straight up from here to 4,700, that would be highly unusual given years and years of market history, because September actually tends to be one of the worst months for the S&P, for the NASDAQ, for a lot of individual names as well. So I would say highly unlikely you get this big vertical move in the month of September, which is why I could see us sort of backing and filling for a little bit more before we sort of set the stage for a move higher. And I think setting up for a rally in November and December, which tend to be the seasonally strongest parts of the year, that's how I think you get to that peak. So my base case, as I've sort of talked around it, is I think we back and fill a little bit more here. I think This week in particular with the Powell the comments, I think I heard you mention, Dale, when I was logging on, or one of the other speakers did, about how the market has tended to rally around Fed meetings. That's 100% true, and I would say it's a psychological reason.
That's the last time you and I talked was on the last Fed meeting.
That's exactly right. And there is a 0% chance, in my opinion, that Powell comes out and gives anything but a very constructive picture about how well the Fed is on top of inflation and how it's all manageable and everything's working and QT is no big deal and it's all going to kind of work out. And that optimism is what's fueled these bounces. But what's happened soon after those bounces every other time too is we fizzled out very quickly. And that's how we could bounce back up maybe to the 200-day. But I think we have a little more backing and filling before we could really mount a significant rally. So my base case is sort of chop around here and maybe a bounce going into the weekend. We rotate lower, and well, I don't know. We retest the lows. I think that's pretty aggressive. I think we sort of get down and retrace some of those gains in June, in August into September, which tends to be seasonally weak. That sets us up for a nice run going into year end. Okay,
so into the midterms. I know some people looking for cycle lows at the end of October. What are the standouts that led this rally? Is it the old guard, or is it cyclical in nature? Is there any character change in the sectors that are leading the way this time, or is it the same as it ever was?
No, and I think the best way I would show that is probably talking about interest rates, which you and I have talked about most of the time, I feel like, on the show. I mean, 2022 has been about the dollar and it's been about interest rates. And I feel like equities have been, I was always taught that the bond markets lead the stock markets. And this year has been a great illustration, particularly in the leadership themes, why it's important to look at interest rates. Back at the end of last year, the interest rate environment was going higher, but we still hadn't gotten above the high from earlier in 2021. And that was the big question: was, are we going to go to new highs? Right. And I think that was a while ago. That was like a 1.5 points ago in yield terms, in terms of where the 10-year was. From there, we moved higher. And the first 6 months of the year, if you remember, growth completely out of favor. And the second panel down here is the value versus growth ratio, right? So this is going higher. Value stocks are outperforming. First 6 months of the year, it was value over growth. Energy, obviously, a huge outlier to the upside, but other sectors like materials did very, very well, while the FANG sectors struggled. Starting in June, and actually a little before June, you actually start to see that change a little bit. And when the 10-year sort of gets above the 2018 highs, that's actually right when growth starts to reemerge. And so the leadership profile over the last 2 months has been dramatically different, right? And really June and July, where it's technology, communication services doing very, very well. Not as much consumer discretionary on a broader basis, but those other two for sure. And that's a big change. And the reason why they're able to rally, and the reason why the benchmarks, which are very growth heavy benchmarks, the reason why they were able to bounce from the low in June to the 200-day moving average is because of the leadership from those growth oriented sectors. And that is given space by the interest rates coming down and the dollar lightening up right after being so strong. In August, though, you can see that the ratio is just starting to turn higher. You can see, if you look at the last week, most of those days, the energy sector has been number one, and it's not been close, right? It's been energy and then everything else again. So all of a sudden, the sector profile is looking a lot like it did in the first half of the year, as rates are pushing back higher, as the dollar is bouncing higher as well. And so I think the way that we get this sort of choppy, maybe retest kind of feel over the next couple weeks is because rates can move back to the upside a little bit. The dollar sort of, maybe re-exerts itself to the upside. And it would be really tough for the major benchmarks to rally in the face of those headwinds.
I don't know how many times I've tried to pick the dollar top where I get rewarded short term, for a decent move, and then it's in my face again. What's the dollar look like to you? Double top, should make a new high here, right?
So from a technical perspective, really, really interesting. I would say, I mean, my sense would be the dollar has further to go to the upside. But from a technical perspective, we are at the very deadly pattern, which is a double topping pattern. It's one of the most classic patterns in technical analysis, which is very simply, we establish a level, we pull back, and then we retest it. And this is the big question mark moment. Do we have enough momentum on the chart to power through that resistance? Now, what's interesting is we had that happen.
But look at that RSI reading. It looks like it peaked in April.
So that is exactly right. We've had this double top pattern a bunch of times so far in 2022, even the second half of 2021, and every one of those times it's powered through it, right? But an uptrend doesn't last forever. And what gives me pause to a raging bullish dollar thesis is this momentum picture, right? Peak in momentum was in April. We made highs a new high really drove there in July on lower momentum. And then again, we're now, testing new highs, and we're not even overbought yet. So a stock or a chart in an uptrend where we make new highs, but it's not overbought is always a bit of a question mark. Now, again, the market can always power through that and then re-exert itself, which is why there should be a big line around 109 on the dollar index. Can it get above there? And I think if and when it does, that should be the signal, to be thinking more on the short side of things like the NASDAQ, because it would be really tough for growth to rally with that happening with the dollar index.
Okay. And the gold miners have a little bit of a heartbeat despite the strength in the dollar. Wondering what it looks like to you.
Yeah, so gold is tough. And I mean, out of all the charts that I review, I mean, we used to talk about things being chart challenged. And I think gold is maybe one of those in 2022. Yeah. I mean, it's been a tough environment. And the argument for buying gold stocks, and I can bring up like, Newmont, probably the most liquid example. The argument for buying stocks like this is that they've gone down a ton. And I've never found that to be a great justification for owning anything, right? The fact that it's gone down a lot. And I was always taught, never confuse the bottom of the page with support. Just because something's gone down a lot doesn't mean it can't keep going much, much lower. Now, what you get on the chart of like NEM and some of the other gold miners are the same, is you're getting a potential bullish momentum divergence, right? Where it's making new lows in the last week, but on less negative momentum, right? So the price is sloping downwards, momentum sloping upwards. That often can be a contrarian buy signal. What you'd need on something like Newmont Mining is to get above the swing high, right? So you'd have to get above these levels, I think, to sort of validate that signal. Hasn't happened yet. It's bouncing a little bit this week, but I need to see a little bit more.
You picked the worst of breed. I mean, okay. I mean, people call Newmont the best of breed, which it's been for years, but since the years, the earnings about, I don't know how many months ago, when it gapped down, it became, you pull up any other gold mining stock, it doesn't look as weak as Newmont.
Fair point. And the XAU, which we're looking at here, actually put in a higher low in the last week. So granted, right? Yeah, fair point. Yeah. When you think of the group as a whole, though, I still think, how different does this chart look than any other equity you could probably bring up, say for like a media name or something that's just been downtrodden. Most stocks obviously look way more constructive. And so I think just like we talked about with growth stocks that needed to get above their June highs, I think for gold stocks, you need to put in a higher low and then make a new swing high. And that's what we've not seen in any case. I don't think yet. I think the chart of gold.
You think that the market is hated. You look at sentiment readings in gold and the euro, and they're if they could put up a minus sign, they would.
That's exactly right.
Yeah. So again, it's contrarian. Oil,
very much so.
Can you explain why oil shares have been doing so well, even though oil peaked at 130, broke to about 85, $86, but the oil shares keep charging?
It's amazing, right? And usually, I mean, when I was learning about energy stocks, years ago, and was kind of introduced to it, I was told it's an oil call. It's a macro call. Figure out what's happening with oil and you get what's happening to the oil stocks. And for the most part, over the long term, that tends to absolutely work. I mean, that's been the case. But it's not the case right now. You're actually getting a bit of a disconnect, right? So crude oil, as you mentioned, I think from a technical perspective, clearly still in a downtrend below its 200-day moving average, testing it from below, which is interesting. Yeah. And it's looking similar to kind of what we saw in the fourth quarter of last year, which was a brief dip below the 200-day, and then we started to mount a recovery, and getting back above the 200-day was one of those great signals that this was emerging as one of the great trades of, I mean, even the decade, maybe, right? This rally in energy in the first half of the year. And that really, really showed it. You know, you got to remember, though, that even with the choppiness in oil we saw in the second quarter, energy stocks were still actually doing pretty well, right? I mean, it was
if you got out based on WTI of your oil shareholdings, you missed a lot of upside. So, I mean, if you look at that,
I think, yeah, that's absolutely right. So what's happening to oil, I mean, to energy stocks is, I think, you know, you think about that chart of interest rates, think about the 10-year yield, you think about growth versus value. Value stocks doing incredibly well in the first half of the year. You know, energy gave back a lot of those gains, but still, you know, one of the few sectors up for the year back in June and July, right? And now again, starting to retrace it. This has done what, you know, gold stocks are kind of down here right now. And you look at what happened with energy. It's sort of, you know, they made a higher low, made a new high, and it's just sort of re-exerting itself to the upside. It's starting to show once again, like it looked in the first half of the year. And again, what this sort of fits into where I feel that the market, the indexes, at least for now, are going to have a lot of difficulty mounting a significant rally. Because if you think the S&P and the NASDAQ's going higher, it's not going to be driven by energy, right? These days when energy was up 3-4%, the averages are flat for the day, right? Or even down a little bit, because it's the growth sectors that really drive the benchmark return. So I could see a scenario where energy stocks continue to do very, very well, even though September is tough for stocks, even if the market as a whole retrenches a little bit and backs and fills and sort of bounces around key support levels. A sector like energy can actually do brilliantly, and I'm seeing a lot to like on that chart here.
Okay, my partner in crime, Stelios, got long uranium ETFs yesterday. I know it's kind of it's even a smaller sector than gold and silver miners, but is it going to get the same type of energy play just out of desperation because of Japan? The charts look pretty good, don't they?
It could be, and to be honest with you, the general commodity space, I mean, to be honest with you, is improving the same way. Now, I mean, something like the DBC is obviously very energy oriented. The challenge with a lot of ETFs that we track, they're very energy heavy, but you know, this is kind of looking at some of the major you know, commodity ETFs. And in general, there's a lot of strength in the commodity space, turning all around. And again, that's very different than what we saw in, you know, the beginning of the third quarter. And again, I think that fits into sort of that change of character of the market and how things might be evolving a little bit different than June, July. I think August into September starts to feel a little different.
I know you're a technician, David, but where do you think Powell's going to come down tomorrow at his big speech? And we're sitting here with our mouths wide open, waiting.
Right. So I go back to, as a technician, I look at the evidence, right? And I like to think about what the market does leading into these announcements, how it tends to digest things during the day, and then what happens soon after. And if you look at 2022, it has been optimism going into the Fed, and now really sort of a quiet period, which is pretty natural, right? Kind of have a lighter, you know, sort of sit on our hands and see what happens. But during the press conference and in the, you know, hour and a half after, 2:30 to 4 p.m. Eastern on every one of those meeting days, you've seen a nice move. And in a lot of times, you know, some days we've reversed very, very quickly, but most of the time we at times had a nice sort of rally soon after. But every one of those times it's gone back lower, right? Because the data that we see, right, on inflation, on on jobs and all of that starts to just the general rate environment. It all sort of reminds investors, I think, of the broad headwinds that still remain. Powell's job is to encourage you as investors, as traders, to look past the challenging data that is still kind of going to be there for a little while and think about how what we're doing is going to work just fine.
So you don't think, like a former guest I had, that Powell just wants to help the Democrats in the midterm?
I don't know if I would make that call, but I definitely think he certainly wants to calm the anxiety of the market for sure. What's different this time, and obviously this isn't a formal meeting. This is the Jackson Hole conference, but the comments I think are going to be very, very noteworthy. I think the big difference now is we've changed from quantitative easing and how does that unwound, which has now happened, to now quantitative tightening, which is literally the Fed reducing the balance sheet, that has actually not happened a ton, right? We don't have a lot of history to look at, a lot of observations. You can look at when QE has started, you can see when QE has stopped, how the market sort of reacted going in and coming out. And I think we have some good patterns to dig into. Quantitative tightening is very much an unknown. And I think as the market digests that, there could be some fits and starts. It's less of a known thing where the Fed is actually being a little more restrictive than it has been in quite some time. And again, I think if nothing else, I think the VIX has bottomed out at 20. I think we see higher volatility because of higher uncertainty between now and year end.
Okay, we're going to break 38.
Break 38 on
VIX.
On the VIX, boy, possibly. I don't. That sounds extreme to me. And the range in 2022 has been sort of 20 on the lower end, 35 right at 38 is sort of the upper end. That's why I don't think we get above there. But think about what the market would do if we get from 2022 up to 35. That's how the market sort of backs and fills and sort of hits one of those lower levels down around the 50-day moving average that feel a long ways away, but really are not that far.
Okay, so best way for people to get a hold of you. And Marco, I see your question. Why don't you get a hold of David, someone that wants to talk to you about how you run several analysis on the RSI. So what's the best way for people to reach you? Would it be on Twitter at DKellerCMT, through your show, The Final Bar, which is a great show. You're, as good as you are as a guest, you're as good or better as a host. And,
I don't sing for my guests though, Dale, so I'll have to up my game. I'll see what I can do.
I'll send you a DVD. And and anyway, for someone that has questions after this interview, what do you recommend?
Yeah, of course. So social media is great. At DKellerCMT is where I'm at on Twitter. I look forward to engaging with people there. My show is on Stock Charts TV. I do the Closing Bell show every day there. So you're welcome to join me. And our previous episodes are at stockchartstv.com.
And then you take questions during that show too, don't you?
I do a mailbag twice a week, and we get some really thoughtful questions from people. So you can email me at thefinalbar@stockcharts.com, and I can answer the question on the show.
Well, to wrap it up, if it was my final trip to a bar, I can't think of anyone I'd rather, clink beer glasses with, David. So thank you very much for sharing your outlook and your 4,700 target and the hows and the whys behind it. Really appreciate you coming in over the years and edifying our F.A.C.E community, my trading warrior brother.
Always a pleasure, Dale. Be well, stay safe, all right?
Okay, everyone. So that's a wrap. David Keller, everyone. Great technician and a thoughtful guy, cares about his people. Check him out and check out the team in about 18 minutes for the morning edge. Keep your edge, but above that, don't just count your pips, count your blessings. And we'll see everyone to wrap it up before Paul gives us the word tomorrow. You're very welcome, everyone. Thanks again, Dave. Adios.